So question one, Shirley, let's talk about mortgage rates, fixed versus variable. There is a lot going on right now. You are an expert and tell us
Oh,
what is happening.
very much. There's a lot of volatility or movement, I should say. Volatility, I use it with a lot of care in that. It's not intended to make a lot of people start running for the hills at all. But as an example, over the course of the year, as you already know, we've had a lot of movement. For a while there, almost every week, there was an announcement of a mortgage rate increase. So we've had our variable rates sitting somewhere around the 3.115-ish range starting. That's about the posted. And then for the 5-year fixed close, we're looking at about the 5.1 to 5.29 range. And now part of the header that we've put up there is variable versus fixed. With the variable, it'll always float with the prime. So that's why some people are listening very intently to the announcements from Bank of Canada, which, by the way, the next announcement is July 13th. The last announcement in June was related to basically should they be moving the Bank of Canada rate. But in July 13th, there is going to be also the economic outlook. And I know you're going to be touching a little bit specifically related to the real estate, which is near and dear to many people. Now, the Bank of Canada rate, there has been a lot of predictions from the various economists that it could be as high as 0.75 to increase. And that's the Bank of Canada rate. It still translates from there into your mortgage term rates. And that's where it moves into making the decision, do you want to move to a fixed or a variable? Now that's a lot of information in one or two sentences, but that's kind of the high level of where the Bank of Canada rate is, where the mortgage rates are sitting at, and where they're going to be going. So undoubtedly, they are going to be going up towards the end of the year, could even be over a percentage. So very, very important that if you're looking to also qualify for a mortgage, so this is also something near and dear to me, everyone always wants to try and be able to get as much as they can and with their income and with the rates. But there's always a stress test that's involved. And in the past, the stress test has always been around the 5.25, and that's because the rates have been very much lower. So now we've actually gone past the 5.25 range. Generally speaking, when you're looking at a particular term one chooses, it's plus the 2% or the 5.25, whichever is greater. So right now we're definitely hitting on the term rate plus the 2%. And sometimes sitting on a variable could help with a little bit of qualifying as well, because again, it is that term rate plus 2% or 5.25, whichever is greater. So as you can see there, it could help with a little bit of qualifying.
Wow. So the rates I've never in my lifetime and having advising for over 20 years have seen them go up this quickly, this
Very.
fast. And I guess what's really on a lot of people's mind is going to be if I was getting a fresh mortgage right now, should I be going fixed or should I be going variable? So according to what you're saying, it really is how much you can stomach. Because if the variable rate right now is 3.15, but it could be over 5% by the end of the year, then some people, are uncomfortable with that. Or you could just bite the bullet and say, I'm going to lock in for that 5% or 5.29% right now. But at least I know for 5 years, I know exactly what I'm getting.
Exactly. And you've hit the nail on the head there, Christian, because there's many people that I've done pre-approvals for, and it takes a while to find that nice home that you want. You find your magic home, then you've locked in from, like, say, about a month and a half ago, and in that course of time, in the last while, almost every week there's been a rate increase. So the movement in itself, it's worthwhile to really consider, okay, if I'm in a fixed, and if your personality or your mindset is, I really need to know what that payment's going to look like, what the rate's going to be, what can I expect? And if you're going to lose sleep over it, the fixed close is a fantastic deal. And especially with the movement that goes, because from A to your final destination, a lot can happen. And if also looking at the variable, many do say to me, wow, that is a really nice sharp rate, but variable means variable. It does go with the prime. So you need to be able to have your coffee, stomach it, be able to eat your meals, and be able to still go to sleep. So
Yeah.
that's important.
Now
Yeah.
I'm gonna talk about a strategy that I have advised clients on in the past, and I'd like to get your opinion on it. And some
Yeah.
people kind of want a little bit of the best of both worlds. And they say, well, I like the variable rate, but I'm a little bit nervous about if it goes past the 5.29. Like if the variable shoots past into the mid fives and they're like, I should have just picked.
Yep.
So sometimes I basically say, figure out what the let's say 29 rate is, and say, let's say you're taking on a mortgage and let's say it's 4,000 a month at the 5.29. Let's say at the 3.15 variable today, if I was to sign today, let's say the number is 3,500 per month. So it's a difference of $500. Then sometimes I'll say, if you like the idea of the variable and you want to take advantage of that lower rate, then you could tell the bank that I will take the variable rate, and the bank will say you're going to have to pay 3,500 per month, but then you overpay it to the 4,000. So
Yep.
essentially every single month you're paying the 5.29 rate. You're paying 4,000 a month, but
Yes.
you're essentially overpaying your mortgage, and the rates are going up. You absolutely know they're
Yes.
going up,
Yeah.
but your bank account doesn't actually change until it breaches 5.29. And all we can do is hope that that never happens, or we hope that it takes years for that to happen. And then what happens is that all of that extra money was going towards principal. So that, let's just pretend for argument's sake that that the variable rate breaches 5.29 in year 3 on a 5-year,
Yeah.
5-year term. Then those last 2 years you're paying more than you would have if you just got the fixed, but you've paid off so much extra principal that it kind of balances itself out. So the upside is essentially higher than the downside, and the downside is it blows past 5.29 within 1 year essentially, and you're in this high range for the remaining 4 years. But I just sort of find that, yes, rates are creeping up very, very quickly. But like in the last 15 years, when I've suggested this to clients, they've always benefited. They've always been out ahead doing this.
Yeah.
In this climate, what do you think about my strategy?
Very smart, Christian. You've always been a very smart man, and that's why you're doing or on the balance sheet on the asset side. So what I do recommend, similarly to you as well, when someone's on the fence about variable versus fixed, because they do like the rate, but they're like, I don't know, like, I don't know if I want to wake up to hearing the news about the Bank of Canada, and then July 13th is coming up. So from July 1 to 13, every morning I'm glued to the radio. So one tidbit, and to your point, actually, when you're in a variable, obviously there's going to be a tipping point of when the payments are going to go up. The magic question is, when does it tip? And it tips when obviously the payment that comes out and what has to go and be applied to the interest portion that payment is not sufficient to cover for that interest. So to your point of being able to mitigate that rate increase and getting your mindset to say, okay, this is my permanent payment for quite some time, you get it above it and you're mitigating that rate increase, because as the rate increases, the cost of borrowing increases too, right? And then that way you can sleep in a sense that obviously you've got your set payment, you don't have to worry. I like knowing my set payments as well. I have a little bit of a risky side, but I certainly like to know that on the first of the month, this is what I'm going to be expecting to see leave my account.
Yeah, like, I have a different strategy because I'm a real estate investor, as you know, as well.
Yes, yes.
My strategy is actually fairly simple, and that is whenever I buy a property, I hedge. So not every property is variable, not every property. And so even when I'm picking a term rate, I will try to make sure that everyone renews on a different year.
Yes, that's right. And
I don't know which way I'm gonna so all of my properties have to, break even or cash flow, but at the rate I buy it at, but when it renews, I'm not sure what's gonna happen. But I don't do a variable with every single one, and I don't do a fixed with every single one. So I kind of try to smooth out.
Yeah, you're making it diverse. You're diversifying, no different from how you plan out with your clients.
Absolutely.
To diversify and make sure that you're not going to be all eggs in one basket. And one thing I did want to touch on, and I think you and I've touched on it a while back. One of the products that's really out there with many of the institutions. So it's not, I can't sit there and make a claim to fame that it's exclusively to BMO, but there is that home equity line of credit.
Right.
And the institutions obviously allow up to 5 segments that can be placed in there. So to your point about being able to diversify, if your total mortgage is say 600,000 and maybe it's approved for a total limit, because we can go up to 80% as long as you qualify for the payment, but you could do split as well. You could do one segment in fixed, one segment in variable, and then you can have the best of both worlds.
Yeah, you could hedge kind of, chop,
but then
fix in the variable.
Yep, absolutely. But yes.
So, I guess what we know is for sure that there's going to be an increase in rates, which means there'll be an increase in variable rates. For those who are already locked into a fix, it won't affect you until, of course, it's time to get pre-approved, get renewed. I guess, to cap this off, to anyone who is thinking of buying a property, they really should get pre-qualified, because we don't know. Next time you and I speak, the fixed 5-year fixed rate might be at 5.8 or 6%, and you might be finding a property in 2 months from now, and you want that lower rate. But I guess one quick disclaimer is everyone kind of feels that the sky is falling and that these 5% rates, some people are saying, absolutely a bad time to buy real estate because it's a 5% rate. I want to wait till it comes down. Back in when I first got my first mortgage, I would have killed for a 5.29.
I know.
I think mine was a 6.8. And if you talk to people, just a little bit older, and they said, we had 12% and 18% in our first homes.
I had 13.
Yeah,
I had 13.
Exactly. So I think that this kind of recent generation is just so used to 2% rates, and they kind of feel, well, I'll wait till they come back down to 2%. That might never happen in our lifetime. And they have to just face the reality. It's kind of like, here in Vancouver real estate. Oh, it's too expensive. I'll just wait for it to come back down like it did with the Americans in 2008. No, it'll never happen. This is the reality of our pricing. This is the reality of the mortgage rates. What's most important that they work with professionals like yourself, like myself, and we sort of say, does this scenario make sense? And with you, you could help them on the mortgage side. With me, I could help them to see, does this make financially? Is this a financial sound strategy? Does it make sense sense to take on this large of a mortgage? Maybe you have your student loans or you have other debts, you're starting a family, or potentially there might be a loss of one income due to a maternity leave. Does this
Yeah.
make sense at the current rates? Should you be going variable? Should you be going fixed? So yeah, by all means, people should absolutely be reaching out before they make that huge decision.
Hi, I hope you got some great information from this last session. Did you know that we give complimentary financial advice on insurance, investments, and real estate planning while in medical or dental school or after graduation? We also give complimentary tax planning and filing during residency. If you'd like to set up a time, give us a call. You have more to gain than you think.